Good morning, everyone. My name is Sarah Sloan. I am a contract specialist with Metro's purchasing department, and you guys are here today for the project cost tracking and cash management course presented by Teresa Carner, who is the regional accounting coordinator with Messer Construction. She is going to go over tracking project costs in order to accurately report revenue and income projections, and has a nice PowerPoint presentation and a great course set up for you guys today. So if you guys wouldn't mind completing the course evaluations, and I will collect them at the end of the time today, I would appreciate it. And I will turn it over to Teresa now. So thank you very much.
Good morning, everyone. This will be kind of fairly informal, so as you have questions, feel free to, kind of raise your hand and we'll go from there. There is probably about 15 minutes built into the end as well for some question and answer time as well, so whatever makes more sense, if it's pertinent right now and you want to go ahead and ask your question, or kind of remain it till the end, whatever is most kind of effective. I guess just a little bit before we get started, there is kind of one overall disclaimer I'd kind of like to make, as with probably all of the sessions that are going on, but probably, in my opinion at least, since this is the one I'm presenting on, for project cost tracking and cash management, it is obviously very specific to your individual business. What your revenue streams are, what your financing positions are, whether you have, credit and loans and that sort of thing. So a lot of what we'll be going over today, you have to keep in mind that, there will be obviously other considerations that you'll need to take into account given your specific kind of position in your specific business. So, but just know these are kind of overall things to consider. And then obviously your individual type of work and business that you're in, so whatever type of area of the project that you work in, obviously then your cost tracking is going to be different than someone else's. So again, these are kind of blanket and overall kind of statements about tracking cost. So let's go ahead and jump in here just so I can kind of gauge who is in the room. Everyone here is within kind of the subcontract world. Okay, and then do we have any, and this is just kind of more for me later in the presentation, do we have any of the kind of MEP contractors in the room? Any of the mechanical, electrical, plumbing? Nope, okay, perfect. Just because of their specialties, we have a little bit of different information I would bring up. So let's talk a little bit. We're gonna actually start first with kind of cash flow and cash flow management. And we'll get into project cost and how they relate here in a minute. So really, maintaining an overall healthy cash flow position for your company really requires managing cost and schedule in tandem as these two impact each other. So, again, every business is different, but some businesses tend to work in very much in silos. And so you have certain people that are involved in the scheduling aspects of your business and other folks that are involved in the cost aspects. And really you have to determine and figure out a way that these two, if they're different individuals or different departments, can really work together, because any change in schedule obviously has an impact on your cost and vice versa. And then really kind of more that kind of silo thinking is really to have a thorough understanding of cash requirements if you have multiple projects going on at the same time. So as you're looking at one individual project, you have some variables that you're going to be looking at in terms of managing that cash flow, but then you really need to take that bigger picture thought process there and think about, well, how does project A affect project B and then project C, and really look at all of them in total as well. Another kind of consideration as you're going through, so you've just been informed that there's this new project out there, some of the projects they were speaking about earlier this morning. And you're really going to start to analyze cash flow at the beginning of the project so that you can ensure that there is enough working capital available. So you start to kind of do this at the very beginning. And then a big kind of thing that we see from subcontractors is we're a general contractor, but what we see from some of our subcontractors is really remembering that when you're looking at cash flow, so you're looking at cash in, so what's coming into me that I can use to pay my bills, and you're remembering to account for any retainage that is being withheld from your progress billings. So you can obviously see where you could get hung up on the fact typical retainage terms for most of our subcontractors are 10%. So as you start to bill, you think you got a $300,000, bill that you're going to put in and all of that. Remember, there's going to be retainage taken out of that and held to the end of the project when typically all of your costs have already been incurred and paid and all of that. So that money that's coming in at the end from a retainage payment is all the way at the end of the project. So making sure that you're really looking at that net billing as opposed to your gross billings when you're managing your cash flow. And then in terms of the cash out, so I now have cash coming in, again, net billings as opposed to gross, and then my cash out, trying to negotiate any type of favorable payment terms with any suppliers. And then if you do have subcontracted work below you, if you have a second tier subcontract, to see if they can follow a similar pay when paid schedule that you'll be on with your general contractor. So obviously anything that you can tie that goes more in line with your cash coming in to cash going out, anything that can follow that same type of schedule. And we're going to see, I'll have a couple slides here that kind of diagram some cash in and cash out. But anything that you can do to help make that follow the same schedule, you're obviously going to be better off. It's obviously one of the reasons why the general contractor has written your guys' contracts to be pay when paid. So that when we receive, as a general contractor, receive money from the owner, that is when really our kind of time frame starts ticking and the clock is ticking as to when we have to pay our bills. So you guys should be looking for those same opportunities when you can to write those contracts and those agreements with your suppliers and your subs in a similar fashion. Okay, I hope I'm not having problems. Okay, there we go. I was gonna say, I hope that's gonna move. Okay, well, I'll walk you through here just a little bit. So if we look, the very top of it is supposed to be, excuse me, job forecast for your billings. So you're gonna look, I took a very kind of simple illustration, not to make light of it by any means, but just for the sake of talking. So if we were looking at, you guys were awarded a project for $1 million. Retainage on that contract is going to be $100,000 if it's the typical 10% retainage terms that I would assume most of you guys have in a subcontracted world. Gives you net billings then that you should really be looking at in terms of cash flow of $900,000. What I have kind of going over here to the right is then looking at it on a monthly basis. What will you be able to bill and submit to the general contractor? So you can't see, but I have 4 months outlined there of July, August, September, and October. Obviously, you have some initial startup cost in the first month. So what I have there is that it's $50,000. $5,000 would be taken out for retainage. So what would be your net billing to your general contractor would be $45,000 in the first month, let's say. Project goes along, we move to month 2, we're into August, and we double our billings and we end up billing $100,000. $10,000 is taking out in retainage, and we now have $90,000 from a net billing standpoint. Job is even, again, to accelerate this so that it was just on 4 months. Now, month 3 comes along for September, and we bill $450,000. Take out retainage, we got a little over $400,000. Then we move, we do a final billing for another $400,000, $40,000 in retainage, so $350,000. So, in a very simplistic world, we had a little bit of cost, or we should have only had a little bit of cost in the billing. We do a small billing in the middle or in the beginning. We grow those up, and we bill out our $1 million over 4 months there. What I have identified down here at the bottom, so we're back in month 1, and obviously cost is going to be reflective of your billing, so you're going to have just a little bit of startup cost in the beginning, hopefully. So I had an example here of saying it was $40,000 in cost when you look at labor, material, any type of net 30 type payments, and then if you had the ability to do any pay when paid payments. So we're looking at that, and let's say it's only $40,000. So just from that simple illustration, even if I take out my, take out my retainage, I would still be, in a sense, $5,000 above. make sense. I know you guys can't see, but to remember what I said, but so we billed 45 grand if you take out retainage, and I, say there's cost of 40,000 to get started. It's hard to follow when you can't see everything, so I'm not going to walk you through all these numbers. The next month we were the same, so I had cost of 90,000, net billings was 90,000. The next month I was at 390, billings was 405. So all the way along across the project, I was able to bill from a net billing standpoint more than what my costs were being forecasted for those months until I got to the last month of October, and then my cost actually exceeded my billings by $20,000. But I had built up more than $20,000 in reserves in the previous months together, so in a sense, I should be okay. So again, I apologize that you are not able to see this, but trust me, the math was all working. July through September, we were in the good, we were in the black. In the month of October is the only time by $20,000. So kind of keep that in mind, even though you couldn't see it, because we're going to talk more about in my opinion, true cash flow and how you should really be looking at it. And we'll see if October was still when we kind of had our first time of timing not working out. So we'll get there in a minute. So any variation, this is why back from probably the very first slide or the second slide, any variation in your cost volume or your schedule can drastically impact this cash flow that you're going to be, analyzing and running through and using to manage the cash on the project. Because as soon as, again, you couldn't see it, but as soon as my costs that I was forecasting, material was billed a little bit early, material was billed a little bit late, anything, the schedule slipped by a month. The general contractor came and said, hey, the owner wants to really push the schedule and we need to finish, 3 weeks early, anything like that. So any of those moves, as I had the 4 monthly columns there, now just drastically shifts what's going on the project. So that is really why you're going to set up this initial cash flow plan in the beginning and look at your forecast for revenue, for billings, for cost, do all of this great forecasting up front, but then you need to constantly review this cash flow plan for your project. Because again, any type of change out in the field, any change from a supplier is really going to affect it. And then on the flip side, any kind of change from the general contractor, if we never do this, but if we ever pay you a little slow, anything like that, again, it starts to shift everything out of the quote unquote kind of perfect world you were living in when you first kind of did a cash flow on the project. And then the other thing, and this is probably where we see one of the biggest, I don't like the word pitfalls, but it's the best description for it. It's probably one of the biggest pitfalls from the subcontract world, is really understanding how your contract terms have a huge impact on your cash flow. So that's why, again, kind of going back, because not that per se the contract terms will change, but really understanding, because you don't know the contract when you initially set this cash flow projection and when you were awarded the project, and you're going to need to really see how that contract is playing out and how the general contractor really does pay and stuff like that. So constantly reviewing this cash flow is very critical. So if we talk a little bit about contract terms, it's really understanding your contract terms. So you have this probably an AIA document of 50 plus pages, 20 plus pages, depending maybe on your scope of work. But really understanding those contract terms with your general contractor. And probably the biggest things, obviously there's going to be stuff about liquidated damages, and there's going to be stuff about delays, change orders, that type of stuff. All of it is very important. Don't get me wrong, all of it is going to have an impact on, again, schedule, which could then, obviously we talked about that in the very, very beginning, impact your cash flow. However, what really, you at the very beginning, when you're just awarded a contract, what you really are sitting in the driver's seat about, you don't have any control right now over liquidated damages. You don't have any control right now over, schedule or change orders. That's all going to come kind of downstream on the project. What you do have control of at the very beginning of the project, right as you kind of execute that subcontract with your GC, is understanding what is really required of me for contract compliance. So looking at those articles and sections that talk about a bond, a letter of credit, joint check agreements, those are the typical kind of payment mitigation type risk mitigations that we at Messer use. Other general contractors here, in the area might be using others, but those are really kind of our safety nets and stuff that we, build in and work into our subcontracts. So again, that list could have 3 or 4 more if there's, kind of something else that a general contractor is using. But really understanding, so I'm a bonded contract now. I need to get that bond. I need to get with my surety company. I need to get, all of my paperwork in order from a bond standpoint, or letter of credit, or irrevocable letter of credit, get with my bank, figure out what's needed, and get that submitted to the GC. And then the other thing is any type of insurance requirements. So you're, required for $1 million coverage, $2 million, $3 million, whatever your scope of work and your description of work is. All of those requirements will be laid out in it. I know at Messer we attach sample certificates to our subcontracts and attach those to the back as addendum and say, your limit is $1 million policy. Here are your sample certificates. Please take them to your insurance agent and get those completed. So again, I don't know if all general contractors do that, but get your contract, kind of run through everything and see what the general is saying about the insurance requirements. And really where you're in the driver's seat right now is get these items submitted, turned in, approved, everything ironed out before you are even on site. So you've been awarded a contract today. You don't, start on site. It might even be quick. It might be 2 weeks or something. But as soon as you're awarded that contract, really getting all of that information and all of those documents secured, approved, and squared away with the appropriate parties is critical, because you don't want to be on site, incurring cost, getting ready to submit your first bill, and find out from the general contractor, well, we haven't got your bond yet. So you're doing a great job. Thanks for playing. Thanks for being on site today. Thanks for all this hard work you've been doing. But until we get your compliant bond, we're not going to pay you. And I tell you, I've worked now and I've only ever worked for a general contractor. I've never worked in the subcontract world. I don't want to hold your payment. I don't want to. And I speak just for Messer. I can't speak for any other general contractor in the area that you might be working for, but we don't want to do it. We have the same kind of metrics and standards when we go to propose on stuff with owners. What is your payment relationships? What's your payment history? We have owners all the time that run Dun & Bradstreet reports on us and stuff. If subcontractors, you folks in the room, we rely heavily on you to give us favorable ratings back to people that we pay on time, we pay, fairly, all of that stuff. We don't want to hold your money because it just has a negative impact on us as well. We also know that when you come to the table to bid our job, that you mark up everything, 10% or whatever to cover the fact that, wow, I worked with Messer, on 3 other projects, and they pay really, really slow. They have, all kinds of red tape and hoops to jump through to get my payment. I have to mark up so that I can, the price of money. There is a price of money. So, and then you end up marking things up when you bid us. So there's a lot of disadvantages for us to not pay you. So again, speaking just from the company that I work for, but I would assume, it's a very tight industry, that any other GC that would be standing up here would tell you the same thing as well. We don't want to hold your money. So get these items turned in, squared away, everything, all I's dotted, T's crossed before you're ever even on site. Bond never comes up as an issue then as to why you're not getting paid. It was already taken care of, before you ever stepped foot on the construction site. And then really looking through that AIA document, I believe, I didn't look at one before I came in here today. I believe it's like Article 9 is your payment section. Regardless, whatever article it is in your particular subcontract. What is required monthly for me at pay application time? So I've already went through and I understand what I need to do just to get my contract compliant. What do I need to do every month on a monthly basis so that that GC is happy with what I've turned in from a document standpoint and an accounting standpoint? So typical things, again, other generals might require other things, so this may not be a kind of a all-encompassing list, but it's probably a completion of an AIA G702, G703 if you're tied to an AIA subcontract. Any type of joint check information, if you are a joint check, if that was a contract compliance, you're gonna have some initial paperwork up front, but then you are gonna have a document every month that says who else needs to get paid with this as a joint check agreement. So getting that turned in every month. Any types of waivers or affidavits that are either required for the state of Tennessee, for the project in general. Prevailing wage reports, if it is a prevailing wage, obviously, project. Any of the necessary reports that need to be submitted. Typically, those are always, at pay application time. Usually the GC and the owner wants that submitted monthly with the monthly billings. And then if there's any other owner or project-specific forms, obviously, we heard a lot about kind of the minority and disadvantaged business owner spend and how it's being tracked on every project. So typically, we ask for some sort of, form about your spend and that type of stuff. And then kind of on the same side as understanding or getting those submitted before you're on site, know the deadlines for submitting these every month. And I encourage you, the staff that I kind of manage and oversee at Messer is all accounting professionals. I can't tell you a bit about, the drywall or the carpet or, your area of specialty that you do from a construction standpoint. But what our team of professionals from an accounting standpoint do, work on, and what our role in the project is to make sure that there's contract compliance there and that there's, pay application compliance and all of that. So again, we're not trying to hold your money, but as much as it's, you have to do certain work out in the field for the construction project, it's kind of all those, back of house office type stuff that we have to do. So I would encourage you, if you're working with a general contractor that you've never worked with before, call somebody, email somebody, something, ask them, who is my point of contact when I submit my bill every month? Who's gonna be the quote unquote accountant or, whatever their title might be, but who's gonna be that accounting and administrative person on my project? And get to know them and become friends with them. It will make your life a lot easier if you can, pick up the phone and say, hey, Teresa, I'm getting ready to submit pay application number 2. I haven't heard back on number 1 yet. Is everything good? Is there something I need to do different for you? What do we need to do to make sure this runs smoothly? They will appreciate it as much because, every time something kicks up in our system that says, nope, you can't pay them, you have to have, joint check information, you need a prevailing wage report, whatever the case may be. Again, we're pushing hard corporately to not hold your money. So they're feeling the pressure internally to say, are you contacting these people? Are you getting compliance holds removed? So they want to be your friend just as much. And then in addition to that, so we've just ran through, you've spent, the last day looking over your subcontract with the GC and really, you think you understand everything from a contract arrangement in terms of contract compliance, what you need at pay application time. What you also need to understand, and you don't have to look at, it's again another 100-page document, but is understanding that prime contract, at least to the level that's going to affect your cash flows and your payments and requirements that's on the GC kind of from a document and contract compliance as well. Again, there's going to be stuff in there that is not necessarily pertinent and important at the beginning of the project. It may come up later, how our change order is going to be handled. Again, stuff about, any type of like liquidated damages, delay, anything, a slip in schedule on the completion date or anything like that. But understanding, because within your subcontract, if you actually do read all of it, somewhere in there it says, then you are tied to the prime contract between the general and the owner. So all of the terms, it's really a flow down and a trickle down effect, that all of the terms from their contract you're held to as well. So understand that. Again, I'm not to say that there aren't other important things in there. I'm sure there's important things about safety and things that I don't deal with. But since you're sitting in here, I'll tell you about the ones that I care about. When is the monthly billing going to be submitted to the owner by the general contractor? So that's not going to be in your guys' contract. So if you just read your AIA document, you're going to see when do I need to submit to the GC. But take at least a few minutes and look at that prime contract and say, when does my general submit to the owner so that they can get paid? Because again, typically, now unless you've worked out some other type of arrangement, you are on a pay when paid arrangement with the general. So understanding when that ball really starts and when the clock starts ticking is important as you're going to look at your cash flows. And then what are the payment terms between the owner and the general contractor? So I think it's very important for you guys to understand, when does it start? When is that GC actually going to turn the bill in? And then how long does the owner have until they're late? Because let's be honest, sometimes they will pay early, but it's not as common. You know, it's what we all do personally too. You know, the bill's due on the 15th. Most of us don't pay it on the, the 1st. We typically wait. We don't want to be late, but we typically wait until the 14th to pay it. So it's a good assumption at the beginning of a project when you first read that contract to assume they're probably going to take the entire, payment cycle to pay. So we've looked at our contract with the GC. We've looked at the GC's contract with the owner. We think we understand how all of this is going to flow from a kind of contractual standpoint, but how does that really impact cash? And what does that really mean to me when I'm looking at cash flows on the project? So, and I took, again, kind of a standard subcontract that we use at Messer. So if you're kind of running into different things on a specific project, might have other project-specific requirements, or obviously other generals might do it, a little bit differently, but the process and the flow will all make sense here as we kind of walk through it. So typically for Messer, costs are going to be billed from the subcontractor on the 20th of the month. We typically do 20th of the month as a pencil copy from you to us so that we can review it, make sure we are in agreement with the percentages and the total completed and stored to date and everything that you're billing from a kind of progress standpoint. And then typically any revisions and all of that, and then a final copy is on like the 25th of the month, But unless we're not approving something, nothing really changes from a dollar amount unless we've need to change something. So that's why we're gonna keep it at the 20th and say yes, it was quote unquote a pencil copy, but that was just so they could see it and they could approve it and everything. That's really what I need to use as my starting. So what did we actually have to do on the 20th of the month? We needed to accurately forecast cost for the final 10 days of the month. Now that may not seem like a lot, like why do I need to necessarily cover those costs? But we're gonna see in here in a minute how these contract terms really impact. And if you're not kind of picking up that cost, because some of these costs on the last 10 days of the month are going to be immediate cost. It'll be payroll to your, your staff and that type of stuff. So accurately forecasting, what am I going to do? Because my pay application should be, for a calendar month. So what am I actually going to do for that next 10 days of the month? And then again, because I'm going to be a broken record on this part, submitting all the necessary paperwork on the 20th of the month or the 25th with your final, whichever, some GCs don't want all the extra paperwork until it's a final copy. But regardless, when you're submitting that application, whether it's the 20th or the 25th of the month, all my waivers, all my joint check stuff, all my prevailing wage reports, any extra, owner or project specific report, get it submitted that day. Because then again, we don't run into we've been paid by the owner and now the GC's telling me that I didn't attach a waiver and an affidavit to the request. And then again, some typical terms for us is typically then the GC submits the bill to the owner on the 1st of the month. We will see kind of commonly that it's anywhere from the 1st through the 5th. So obviously, again, 5 days may not seem like a lot, but 5 days would shift the cash flow and the cash in by another 5 days if it wasn't until the 5th. We're going to use the 1st as kind of an illustration here, but understanding from the prime contract, again, that's where you're going to find that information. When is the GC turning it into the prime? Or to the owner, sorry. And then from that prime contract, I also learned that the owner has 45-day payment. We have a lot of even repeat customers, even big customers. Sometimes it's not always better the bigger that they are. They have more departments, more people, more vice presidents, more AP clerks, you know, whatever the right title is. They got more of them, so they want more people to look at that thing, and they take 60 days to pay. So you do this, you know, beautiful hospital building, you know, for millions and millions of dollars, and they're going to take 60 days to pay, because if you write in 45-day terms for them, if the GC gets, you know, lucky and gets 30 or 45, it'll take them 60 to pay it anyways, because they just can't process that fast. So they know that, so they just go ahead and write 60 in, because they don't, again, want to be late. I mean, they know what they can do from a payment schedule. So we're going to use owner has 45-day payment terms. So again, if we didn't look at the prime contract between the GC and the owner, we'd be sitting back in our office going, okay, I submitted it on the 20th. Probably going to use a little bit of reasonableness that you know it didn't get submitted to the owner on the 20th. So even if you give that kind of extra 10 days and say, well, the the GC didn't turn it into the owner until the 1st, if you don't look at the prime contract, you weren't sitting back and thinking you weren't going to get paid for 45 days though. You're probably thinking a net 30. You're thinking it's at least coming the end of the next month. So I did my July bill, I'll get paid the end of August. No, that GC is not going to get paid the end of August, so you're not going to get paid the end of August. And then typical, again, is within your subcontract now, pay when paid terms, I see anywhere between 5 and 10. So I mean, it depends on, you know, it depends on the GC, it depends on the contract. Obviously, so I could do some great illustration that you won't be able to see. I use kind of worst case scenario and said 10 days, but I'll try to walk you through it when you won't be able to see my slide here in a minute. So what does that really mean? July 20th, I did my pencil copy. I was really good and I accurately forecasted costs through the end of the month. So I got me through and I got myself whole, in my opinion, for July 30th cost. The GC submitted it to the owner on August 1st. So he or she did his, you know, their part, and it's to the owner's hand on August 1st. September 15th is when that owner is actually contractually obligated to pay their bill. Again, just like us personally, if you have a bill that's due on the 15th of September, do you pay it on the 1st of September? Not usually. And it doesn't necessarily mean you don't have it to do, it's just not the way you cash flow your own individual checking account, savings account, whatever the case may be. 10 days after payment by the owner to the GC, now I'll turn around and I'll pay you, so it's September 25th. Pay application was July 20th. Do we remember that part? So July costs are not recovered until the end of September. That is a long time to finance cost. A long time. These first two columns were July and August. What the top shows you is I did my bills, just like my last slide that you couldn't see, that said I was going to bill, you know, $45,000 and I was going to bill $90,000 in those first 2 months. What you guys can't see is that second row underneath says my actual cash in. Because again, it's great in the beginning, and you need to do it in the beginning. You need to do forecasts, figure out what your cash in is going to be or what your billings are going to be. From a cash flow standpoint, though, it's taking all those contract terms and now it's looking at what is cash in. And if you could see it, cash in, this kind of second line on it, doesn't start until September. Because again, from that last slide, we did our July bill and we don't get paid until the end of September. So $45,000 came into me in September. I didn't get anything in July and August. So if we look at that top line, again, you probably can't really see the the heading of it, but at least you can start to see where there are some numbers. So net billings there, again, not gross billings, but net billings. We were going to bill $900,000 on the job. And if you see, this is the kind of, there's carryover information from that slide you couldn't see before. We were going to bill it in July, August, September, and October. When I look at my contract terms and I'm remembering the fact that I'm not going to get paid for a long time, that cash in that I really need to look at for a cash flow and really understand my cash flow, you see that $45,000 that I billed doesn't come over until September. And now it's actually out September, October, November, and December on the project. Okay, does that make sense? You may not be able to see the specific numbers, but you can at least start to see there's a number there in a box. And then down here, and again, we don't need to get hung up on these specific numbers, but down here then kind of below is where we start to talk about cost. And what's the cost and what's the cash out, coming out. So I have some, again, it's meant to be pretty simple. It obviously doesn't run, that simple. But so we had some labor. Again, we would have had it for July, August, September, and October, because that's really the 4-month schedule on the job. That's really how long the job was going on for me. So I start out, I got like 10,000 in labor, then I got 60,000, then I go up to 200,000, then I go up to 180,000 so that we could get the job done. That doesn't shift out at all with the cash flow, with cash in. Because employee me is not going to sit around and wait till September to get paid for my July work. You might have to as owner of the company if it's a sole proprietor. But if you have any staff and if these labor dollars are not your hard-earned labor dollars, none of your employees are going to sit around and wait that long to be paid. So those don't shift, those don't move at all. The next column, again, it's a little hard to see, but it's immediate material payments. So anything that you needed to, procure immediately or pay for immediately. Again, it depends on your type of business and what you're doing. So those don't move either. I mean, I had $20,000 in July that I had to pay because they were immediate materials. I had $20,000 in August and another $10,000 in September. The next line is 30-day payments. So those do shift a little bit. They don't shift as much as the cash in because I'm not getting paid in 30 days. I'm out much farther than that, but I am able to shift those obligations a little bit. I can shift some of that money. So right here, this is month 1, July. It's blank because I incurred it in July. I don't actually have to pay for it until August, okay? What's really nice is the next line, if you're in this type of work, is that's the line that's capturing subcontracted pay when paid. So yes, I'm the sub to the GC, but I got an installer coming in and installing everything for me. I'm going to write their contract to them as pay when paid as well. Because now if you look, everything on that row has shifted out the same exact time period as my cash in. Does that make sense? So again, you maybe can't see the specific numbers, but now I'm running out September, October, November, and December, just like cash in. Okay, you couldn't see the slide before, but I said, trust me. And remember that we were all looking good. Everything was running fine when I look at billings compared to cost until what month? October, the very end. And we were short $20,000 between billings and cost in October. Doesn't seem terrible. I can probably take a 4-month job and in month 4 have to cover $20,000 when I was ahead in the other 3 months. So I'm feeling pretty good about that. Again, you can't really see the numbers, but I am going to walk you through these numbers because these ones are important. Month July, I did my first bill. I didn't get paid anything. I still had immediate cost. My actual cash flow is negative $30,000. Not terrible. I can maybe swing that. August, I did a $90,000 bill. I haven't got paid for the $45,000 bill yet I did last month. I'm definitely not getting paid for the $90,000 bill that I'm currently doing. I still had cost. I had $85,000 in cost. And I'm now $85,000 negative for the month of August. And I'm not looking at anything cumulatively, so it's actually 30 from July, 85 from August, but we're going to look at the months just individually because I'm an accountant, but I can't do mental math very well, so we're not gonna add those up at all. September, I did a $405,000 bill, net retainage, so my net bill to the GC was $405,000. I got $45,000 in because it was my July bill that I submitted for initial cost. That's contractually, GC has paid me on time, owner paid the GC on time, GC paid me on time, everybody did everything they needed to do. I had my contract requirements all pretty and I's dotted, T's crossed on day one. I turned in everything with my pay application. Nobody could have done anything better contractually than what they did. And I got my $45,000 that I billed the first month. But I had a lot of guys out there trying to get this job done in 4 months. And I incurred $220,000 in cost in the month of September. So now I'm $175,000 short. October, I did a $360,000 bill to the owner. I got draw 2 paid, which was $90,000 for, again, more initial startup cost. I had $295,000 in cash out the door in expenses. My math comes up with negative 205 for that. How's that feeling? That's not feeling very good. So obviously, I mean, I need something to help me to do this, and that's where we're not going to get into that because that's more your specific, whether you have some sort of loan, whether you know what I mean, however you're going to do that. But obviously, you can understand and see somebody's going to need to step in and do something to pay my bills. Now, again, it's not all doom and gloom. Construction's not all bad. In November, I didn't have to do a bill to the owner or to the GC. I've already billed all my costs. My contract is done. October 31st, I was done on the project. I walked away. But November, I'm going to get $405,000 coming in as cash in. That's that September bill that I billed. So I'm going to get it. I'm still going to have some cost because I was able to do some pay when paid contract terms and all of that, so I have some cost. But I only have $150,000 in cost that was tied to those receipts. So I'm now plus $255,000. So it's good. The project was profitable. You couldn't maybe see all the numbers. It was $1 million project initially, and I estimated $900,000 in cost. So I was going to make $100,000 on this project from day one. But I have to go 205 in the hole from a cash flow standpoint to make that $100,000 in income. Then in December, again, I don't have any bills to do. I've been off the project. I've moved on to something else. And I'm going to get a nice check in the mail for $360,000 from my October bill. I do still have some cost associated with that, though, because I wrote some pay when paid payment terms. But it's $120,000. And I'm now 240 plus. So I've been able to replenish whatever I had to use to get me through the project. But if I don't have anything to get me through the project, I'm never going to get to November or December. Does that make sense? So a couple more just kind of additional considerations. Obviously, kind of my, illustration there shows you contract terms is what's really going to impact your guys' cash flow and show you what you need to do. I think there's a few other things you should consider, probably not as drastic to illustrate there. Know who you're working for, both your general contractor and your owner. I mentioned that in the very beginning as to why Messer doesn't want to hold your money. We need favorable relationships with you. We need you to give us good references, that type of stuff. Why do we need you to do that? Because our owners or potential lending institutions, whatever the case may be, will call upon you guys. Feel free to do the same. If you have never worked with Messer Construction before, you're getting ready to sign your first contract, don't you want to know how does my balance sheet look? Don't you want to know, from a credit reference or a trade reference, what are these people like to work for? Your guys in the field probably do it. But do you do it from a cash flow standpoint, more of an administrative accounting understanding? How do these guys pay their bills? what's their credit rating, that type of stuff. If you've never run a Dun & Bradstreet report, it's easy to use. You get on their website, name, address, search, buy. And they'll tell you payment history, they'll tell you credit ratings, how likely, kind of is this company to default on their obligations, that type of stuff. We run them all the time on a new owner. Because I want to know if their payment terms are 45 days. Again, we already talked, it's not likely I'm going to get it early, but is it likely that I'm going to get it in 45 days? Do they typically pay within their payment terms? Ask for references, either of them. Ask other people that you know in the industry. Hey, have you ever worked with Messer Construction? Solicit your own references there. And another thing to understand is the funding sources of the project. Sometimes that's harder to find out. Now I know over there this morning they were, able to tell you that, but that's because it's, public and it's information that they have to share with you. Owners don't necessarily have to share as much about the funding sources, but usually somebody knows or can help, you can have a conversation about it. Or as you start to build relationships, especially with your general contractors, they'll tell you if they know. But understanding just because I'm, whatever entity, just because I'm this hospital and I'm building a $100 million hospital, that doesn't mean I got $100 million sitting in the bank, just waiting to cut checks as you send me bills. What it means is I've cash flowed it as well, and I can make it cash flow, but I got some months there where I'm negative as well. And I'm hoping through by the end of the project, and then by all the extra additional clients I'm going to be able to take on, and revenue's going to go up in years 2, 3, 4, and 5, I'll replenish everything that I had to use to build this. But it doesn't mean they have $100 million sitting in the bank just waiting to cut checks. And this, I wanted to bring this up. This is kind of a delicate, though tread lightly type thing. So I bring it up, but I also tell you it's not the end all be all, here's my fix. Because there's a price to do this as well. But if you really do cash flow that out and you say, wow, I'm okay in those first couple months where it was, and I don't remember the exact amounts, but it was like 30,000 and then it went to 180. I'm good there, but wow, that month when it hits, 215,000, that's where I struggle. Hey, Messer, instead of this, and maybe you look at it as a month-by-month thing as opposed to my entire contract, a GC would probably be more likely to do that. But hey, Messer, things are a little tight here on this. What if instead of in month 4 in October, instead of me being pay when paid and being out that far, what if we did a net 30? From the GC world, I will tell you there's a cost for us though as well, and I'm not just going to, most likely, unless you catch a GC on a good day, a very soft day. Most GCs are not just going to say, yeah, okay, so your bill was 250,000, I'll do 250,000 in net 30. But with especially the way interest rates are and that type of stuff, if instead of 250,000, you give me a 1%, 2% discount, 1% may not be enough, 2% discount, and we look at that, I'll go net 30 with you. Again, I bring it up because I think it's something to keep in mind, but I bring it up as a kind of tread lightly. It's not the end all be all. You would have to go back, you would have to cash flow that, you would have to see how I'm not going to recoup. The other way, you're recouping all of your cost. You just don't recoup it when you need to pay it. Now I'm I'm taking a discount on this. At the end of the job, I'm not recouping all of my costs. So I no longer made $100,000 on the project. I made $100,000 minus whatever discount I had to get from the GC. So it's out there, it's a thing you could use, but I'm not saying it's how you solve all your problems. And the GC may not agree, so don't don't hang your hat on that one that, oh, I'll just ask them for a discount and they'll give it to me, because they've done the same thing, and depending on how deep their pockets are, they may not be able to cash flow it as well. Questions, comments, these work together, but we're going to shift a little bit into project cost. From a project cost and project cost tracking standpoint, it's really the kind of art of capturing true project cost. Labor is not just the wages that you pay to your individuals. You need to think about labor in total. So it is obviously those wages, it's fringes, medical, retirement, vacation, it's all of your taxes, your FICA, your federal unemployment, your state unemployment, all of that. And then there's overhead items. I mean, there are costs associated with having employees. I list training costs there. There's, if you use ADP or something like that to cut your checks, if you have a payroll person that you pay. I mean, there's a cost of having employees. What is nice is your ability to shift all of that cost to project cost and let the GC and the owner reimburse you for those overhead, what you would consider overhead cost, and not have them sit just in overhead. Obviously material, that one's easy. Machinery or equipment is easy. Then you have overhead for the building. So I have costs to keep my office running, to have, office people, supplies, equipment, that type of stuff. Those should remain pretty constant. Maybe not the office supplies, I shouldn't have thrown that one in there, sorry. But my rent on the building, my lease, all that type of stuff remains constant. Then you would have your indirect cost as well. That's gonna fluctuate with my volume of work. Because I have more indirect cost, the more volume I have. And then it's really having kind of a hierarchy of cost accounts. So it allows you to provide the adequate breakdown at a cost standpoint at the appropriate level of detail. So I no longer am going to say I do decorative millwork and that's what I do. And this project was, to my example, $1 million project. And that's what I know. It cost me $900,000 to do the decorative millwork on project X. No, I want to know that it was $900,000 for, $10,000 was in trim and $20,000 was in this, and this is where I can't speak as intelligently because I don't work the construction world from that standpoint. But whatever your right and appropriate amount of, description and breakdown is there. Allows you to subtotal your cost per level. Allows you to analyze cost per activity or division, so I can now start to accurately analyze what does, doors, frames, and hardware really cost me, and not that it was just part of a one kind of bucket of all millwork. And then it's more of a management analysis tool for cost performance by the types of projects or the building types. So I can start to say that decorative millwork on a church is X and decorative millwork on a hospital is, Y. They're not the same. Projects are not the same from that standpoint. But wouldn't it be nice to know so that the next time I go and do a church, I'm not looking at the hospital information, I'm looking at the church information. So the benefits really of having some detailed project cost is those benefits or the budgeting forecast for your site leaders, which goes right back into the cash flow. So these two work right together. They can start looking at specific variances instead of the overall project. So I went over on doors, frames, and hardware, but I came in under on, that's not a good example. So if I separate doors, the hardware for them, I was under, and the doors, I was not. And this is where they can really start to drive results in the field. We stink really bad at doors. We got to figure out how these guys can hang doors faster. And again, it's the labor, it's the installation, it's the material. We're not good at buying it, but we're really good at installing it. So we need to understand how to negotiate better material supply pricing. Or maybe we're really good at buying it, but our guys are not skilled at hanging it. Does it make sense to continue to do it? Does it make sense to subcontract that out? Maybe we should get out of the door hanging business because we're not good at it. You don't know that if you're only looking at doors, all of doors together. You're not looking at material and labor breakdowns, and you don't know that if you're looking at your entire scope of work and not getting granular at all down to the different divisions. Gives historical cost at a detailed breakdown for estimating on future projects. So I think we talked about that a little bit. And then it could be a potential request from the general contractor or the owner. As owners are getting more and more, kind of in tune with the cost and what's my cost per square footage and what does doors, it's coming if you haven't already felt some of that on projects that you've been on. It depends on what owners you've worked with in the past. But I will tell you from our standpoint, we see it more and more that owners are getting more involved and want more information, which then in turn, if we have to give it, where do we get it from? We get it from you guys. So how this all relates between the two, so the project cost tracking and your cash flow management, it's really a delicate balance between growing your company while not overextending on a project. So this project looks great. I'm going to make $100,000 in 4 months, but I have to think about my cash flow there. And that it's true total project cost to ensure that we are covering the true project and not just making job fees. So while out on the front, it looks great because I'm going to make $100,000 in income, did I include all of my labor, my true cost of labor in that? Did I include all of my overhead, if you don't include all of that, yes, you're making project fees, and from a, revenue minus cost of work, you look okay. When we come down to the bottom line, you're not covering all of your true cost. Kind of the saying of covering the nut, well, you have to know what the nut is that you need to cover. And then it's really marrying these two together, or not two, but marrying these together. So cash flow, project cost, and man, I really want to increase my market share and grow my business. But they have to go together. They have to work together and not compete against each other. Real quick, just a little bit, I mentioned just briefly, but we do kind of see some industry trends, and I want to share those with you. Owner audits, I think, are becoming more and more common for kind of all owners. So they require a higher level of substantiation of cost, so be mindful and knowing of that. Owner accounting requests for segregated cost information, so they're getting to the end of the project or all along through the project and saying, hey, GC, I want to know what this room costs compared to that room. I want to know what this area costs compared to that, or I want square footage information, all of that. So for us to provide that to them, which we'll be contractually obligated to do, so we will do so that we get paid, you guys will have to give it to us. Cost plus subcontract arrangements are not uncommon. They might be uncommon for you today in the world that you're currently in, depending on your type of work, because again, my MEP guys are not in the room. That's where we're starting to see this happen first. But typically there's a trickle down, and that it'll be coming your way as well. Maybe not, maybe you're in such a specialized thing that you'll always be this lump sum arrangement, but don't count on that. So you'll be billing cost plus per the contract definitions of what's real cost. And then if you have heard at all about the IPD contract delivery method, where it really puts you guys at the table with the GC, you sign on the contract with the owner, you're held to, more profit potential on the project, but it's a team. I don't want to get too involved into that, but if you want to know more a little bit about what IPD is, but it's a requirement of the players on those projects. You have to be able to segregate your cost. You have to be able to kind of cash flow the project. So if you want to be one of those, it'll be important as well. Yes?
IPD.
Integrated project delivery. So where instead of owner contracts with GC, we contract with subs, the kind of key players on the job are all contracted with the owner. From architect, design, general contractor, typically then it's your MEP guys, and we're all signatory on the contract. We all have a vested interest as to how this project does. It's no more that, the designer doesn't really care if the general goes over budget or whatever, as long as they're managing theirs. The subs under us doesn't, they don't really care if the GC goes over because they're managing their budgets. We're all tied to the target cost of the project and to the total budget of the project. So we all care. I care if you as a designer, you go over because you affect me from a profit standpoint. And I think that's it. So I hurried there a little at the end, I'm sorry, because I think I'm already like over time, aren't I? Oh, okay. I was waiting for questions, comments, anything right there at the end that if I'm not over, I can go back and expand upon. Yeah.
Sometimes I don't work, I'm not a contractor, but I'm with minority business and we work with a lot of contractors. And some of them, their payments are held until they get the certificate of occupancy or, the project is complete. And
That's probably their final retainage payment, or it should only be their final retainage payment.
and that can go on and on and on, and if something's not right.
Correct.
It's not their fault.
Correct. Because the final payments, so retainage payments from a GC standpoint, we're not going to get paid from the owner until closeout is complete. So we've done punch list, we have our certificate of substantial completion, punch list, closeout items, we've turned in all O&M manuals, all of that type of stuff to get our final retainage payment, and we won't pay anyone else either until everyone's, got everything done. Good question, though.
If you like the cash flow, do people just usually have line of credit or something to help with the cash flow, or I understand loan?
Yeah, I mean, lines of credit are used probably a lot more, just because I don't necessarily need a loan of money, you know what I mean? I don't necessarily need that. I need those 2 months in the middle where it got real bad and real tight and I was overextended. I don't necessarily need it to, to keep the lights on in the business, or, I don't need somebody to send me $100,000 every month, like on a loan or something.
Better for a certain type of business, as opposed to sole proprietorship, LLC, corporation, do they give it to?
I don't think so. I mean, because it still depends. I mean, if you're securing it with something, or if it's a completely unsecured line of credit, or if it is going to have, they do secured lines of credit as well. So, it really depends on kind of the specific business in your banking arrangement.
It's more dependent on the need for the project. It's not the entity, but it's what is the purpose of the loan. So the purpose of the loan will determine whether or not you're under a term loan or line of credit.
Any other questions? Yeah.
I got a question about Dunn and Bradstreet.
Yeah.
When you say you should run the reports there, do you recommend that you pay like $200,000 or $300 to get them, or would you get that form?
Right. We're a member, yeah. That's how we do ours, because then you're allotted to pay, depending upon the membership kind of, level that you purchase. You're allotted a certain amount really within your membership. So you pay $200 and you can run, I don't know what the right numbers are, don't hold me to this at all, but I pay $200 and I can run 50 of them for the year without any charges kind of deal. Or I pay $300 and I can run 100 of them and not have charges per report. That's what we do, but we run them quite frequently. So that's obviously more cost advantageous to us. If you typically work with the same GCs and that type of stuff, and you're maybe just going to have a one-off here and there that you're going to run, might be better to pay the $40 a report or whatever. I don't even know what they're up to, these days, because again, I don't ever look at it on a per report pricing. But then I wouldn't spend $200, because if you've worked with the GC on 5 projects, you know what's going on, you've, had references from them in the past, or there's other ways to kind of go about getting, maybe some updated trade references on them without running a D&B. Just calling folks that also work with them. I wouldn't say you'd run a D&B on people you've worked with for a long time in the past, unless maybe you took a break, and haven't worked with them for 5+ years or something. But you should figure that, if they've been paying on all the past projects, they're going to do the same this way. Or D&B would be telling you the same thing anyways, because something's currently going on and it won't have made it to D&B as well. You know what I mean? So. Okay. Well, thank you guys. If you have anything else or think of anything, I mean, I obviously have the next session here in a little bit, and I'll be around a little while after that. So enjoy the rest of your morning.